Welcome, everybody, to the LPL Market Signals podcast. It is March 9th. I am Tom Shipp. I am the head of equity research here at LPL Financial. And today I am joined by Kristian Kerr, our head of macro strategy. Welcome, Kristian. I'm sitting in for Jeff Bookbinder this week for this week's podcast, and couldn't be a better time actually to have you on to talk about macro and everything that's going on with the Iran war, geopolitics, et cetera. And that is what we'll talk about here. Here's my agenda, and we're gonna cover market recap, then dive into energy markets and the war. Look at the some of the typical geopolitical playbook, safe havens, if you will, kind of acting a bit different. We'll touch quickly on a headline that came out Friday on AI capex, and then look at the week ahead. Does that sound good to you, Kristian?
Yeah, plenty to talk about. Not a boring Monday. So happy to get into it with you.
Absolutely. Well, kicking off, just looking at the markets last week, we say the war has upended not only risk markets, but traditional safe havens, starting with equities. S&P 500 down 2% last week. International markets down more. Look at the EFA down over 6%. Emerging markets down almost 7%. Not many places to hide on a U.S. sector basis. Just energy is the only positive sector on the week. Technology did its best to hold up, down just about 40 basis points. And across the board, equities, though, outside of energy, down. Small caps taken on the chin as well, down 4%. And when we get over to our fixed income and commodities, this is where I think we're going to spend some time today. But just looking at the U.S. Ag down 1%, the yields on the 10-year and 30-year up 15 to 20 bips. But down in the commodity section, we do see obviously crude. This was updated early this morning when crude was trading at with 100, but we're down to about 95 now. So it's traded off a little bit on some news flow on potentially releasing strategic reserves across the G7. Another area within commodities we're looking at is grains and agriculture, a potential place of strength in this. And then finally, the U.S. dollar has continued to be bid, breaking above the 200-day moving average. So we're going to take a look at that. But before we get going, we'll just take a quick look at the S&P 500. This chart was updated around 10 o'clock this morning when we traded down pretty low off the morning, but got almost back to flat. But just we're still above that 200-day moving average at 65.86. But as of this screen print here, we were below the 50, below the 100-day. So on a real-time basis, I'd say we're still range bound, but on this chart here, we're not. Kristian, any thoughts here on the S&P before we get into some of the geopolitical things?
Yeah, I mean the futures did trade actually below it in the overnight session. So very big technical test for the market, and we got kind of almost the reflexive bounce that you would expect after a first-time test of such a big, widely followed support. We'll see kind of if it can get momentum from here. Obviously I think the news flow needs to get a little bit better. I think the volatility in the energy market needs to start to come off more meaningfully. But for a first-time test, a major support, just given the somewhat negative news environment, it's a welcome positive to see that we've so far held that. I think bigger picture, we've really been talking about this all year, is the fact that we're looking at kind of what was one of the tightest opening ranges of the tightest ranges ever in the S&P. Market's got a lot thrown at it in terms of what's been going on in terms of, in the factor space and the quantitative space, where you've had a kind of a lot of volatility internally. The average stock is trading a lot more volatile than the indexes, and the indexes have held up well with kind of that volatility going on under the surface. So kind of what you'd expect to see after kind of testing a big level of support like this. But again, I think we're going to need to see kind of the energy markets calm down, see the news flow start to turn positive for us to get a momentum to the upside here.
It's really been the story of the year that, taking a look at the index level is not telling you the whole story, but if, you're a passive investor, do you really care? Right? So that's really been the story we've been looking at in my work. Obviously, all the volatility underneath the hood, presents opportunities, but it's definitely been a trickier market than the index suggests.
100%.
Let's dive into it here. I was thrilled to be, sitting in for Jeff Bookbinder, our chief equity strategist, this week to have you on and talk about, just a bunch of the different geopolitical events going on with the Iran war, and kind of took this in a direction where you'll send us all charts of the week. So we really just kind of pulled together a bunch of charts that can maybe frame the conversation for us, and starting with, I think, even more so than the oil price itself, but the volatility we're seeing in the oil market. We've got the CBOE crude oil VIX, basically. This is the volatility of the oil ETF, and this is one that you suggested. And when I looked at it, I said, wow, we've had a few different volatility shocks in oil in the past 5 years here, particularly looking at the period with Russia, and also towards the middle of last year with Liberation Day, and we've shot well above that. So what is this chart telling you, and how are we thinking about oil broadly? I know the Strait of Hormuz has gotten essentially to a standstill. Now we're starting to see production shut-ins in the Middle East. What do we think here on oil broadly? It's a global market, right? So
yeah, I mean, quite simply, I would say, or I would argue, this is probably the most important chart to be watching at the moment. Now, we can make a case that the way it's constructed is not maybe the best, but the idea here is that it's telling us the volatility within the energy market, and until this calms down, until we get some sort of blow off top or whatever it is, and can kind of be convinced that the volatility within the energy markets is subsiding, it's difficult to get too positive. I'd argue there's probably a lot of complacency in the market with what we're seeing. I mean, oil trade up to almost $120 a barrel just in the overnight session, right? And we're already, as you mentioned, back under 100. So tremendous amount of volatility right now in the energy market. It's basically, it's an energy shock that we're seeing, and what are the implications of that globally? A lot of ink has been spilled on kind of what this quasi closure of the Strait of Hormuz means. A lot of it talks about about a fifth of oil supply is ceasing, probably a little bit less given that there is some pipeline flow. But I think it's bigger than that, because you've got a third of the world's fertilizer goes through that choke point as well. So it's got a lot of implications. We're kind of working through that. I think what the market needs to see is this chart starting to come off. We need to see kind of ships moving through that area to kind of quell some of the angst of what's going on. So I think it's really that simple, Tom.
So you mentioned ships, and this chart right here really, as I was pulling these together, really blew my mind. It's one of those that most of us are not looking at frequently, and one that is really telling the story. And this is really the day rates of very large crude container ships. So these are the primary ways that crude oil goes, and this is what you would call dirty VLCCs, and that's unrefined crude, right? So from the oil derricks, taking them to move to refineries more locally. And the four data series we have here are all originating in the Middle East Gulf and going to different places: U.S., Mediterranean, Singapore, and Japan. And I mean, you can just see that that's the definition of a parabolic rise here on shipping rates. And this is world scale down on price, so it's not in any dollar currency, but it really just you're getting the impact of looking at this, and I think the big difference that what I've been seeing is this isn't like when with Ukraine, Russia, in the sense of the breakdown of moving crude, right? There's always the secret barrels getting around sanctions and whatnot, but this is just straight up standstill of getting through the Strait of Hormuz and getting to where it needs to go. So, like you mentioned, shipping rates. I think this is another one to watch, just to think about, when these shipping rates can maybe clear up, and more so when the passage opens up. Am I reading that right?
Yeah, it's spot on. I think, I would use the word to describe this chart as unprecedented. I think it tells you the scale that we're talking about from the economic impacts. And listen, I wrote a piece the other day, just talking about, there's two ways to think about this, or kind of how the market's thinking about it, is that the range of outcomes, and this is why I'd argue there's been a fair amount of complacency about it. The range of outcomes here is quite huge, right? Quite wide. So I think the markets are trying to, how do you price that in? That's why I'd argue kind of where energy was priced when we kind of ended last week was still not factoring in that full range of outcomes. But kind of the positive, or turning, almost two negatives equals a positive. There's a lot of people out there who think that the scale of this is so big that the powers that be are going to have to figure out a solution, right? So it's almost as bad as it gets. Creates kind of the situation where people come to the table and sort this out. And you can even make the case that, with some of the news flow we've been seeing this morning with respect to G7, releasing some barrels into the market, or talking about that, I think that's kind of what you start to expect. And that's kind of what these charts are telling us, is that these are kind of some fairly unprecedented moves, wide-ranging impacts from an economic perspective, and ultimately, the kind of the glass half full kind of perspective would be that it's so big that we'll probably see people come to the table to try to sort out and figure out a solution here, because we can't go an extended period of time without things moving through that choke point.
I just switched the chart here because you mentioned what's going to bring people to the table. Like, oh, so everyone's going to be mad about shipping rates? No, folks are going to be upset about the impact to them. And so we've got, WTI price. Like, again, this was 10:30 this morning. I've got gasoline, futures, and jet fuel, right? So a few other things that when you think about gas and jet fuel, these are things that impact the economy, full stop. And this kind of plays into what we'll talk about when we get to safe havens. But this is just wanted to kind of highlight, this is the real impact, right? When we start to see these things, is that all the flow throughs to the rest of the economy really start to spike here. And that this spike is, while not as dramatic as what we saw in the shipping rates, it is enough to get folks to the table. And I mean, potentially trigger, I don't want to, belittle the situation, right? That where there's people going on, but does this trigger a Trump taco trade, if you will, right? It gets so bad that, we have to do something to reverse out. That's
Yeah.
where I'm thinking here.
Yeah, I mean, a couple of things. I mean, there's a regional aspect to this as well, right? What you're showing is U.S. prices. Very different story in Europe, right? Europe is much more heavily dependent on what's coming out of the Middle East in terms of energy and kind of driving the economy there. So I think it kind of depends where you are in the world. I think the U.S. is somewhat insulated here, as kind of a large net energy exporter to the world. So I think as crazy as some of these moves have been in kind of product that comes from energy, it's nowhere near kind of as crazy as it's been. You look at jet fuel prices in Europe, the spikes there, the moves in LNG as well. So it kind of depends where you're located and kind of who you're dependent on. Japan is another clear example, right? 90+% of their energy comes from the Middle East. So I think that's another one where people were expecting the yen to be strengthening in an environment like this, and it hasn't, because they are because they're vulnerable on the energy side. So I think that aspect matters. So is it, does the rest of the world, because they are kind of vulnerable here, do they kind of put more pressure? I think that's an aspect that we should be thinking about. In terms of the U.S., I don't think if it were to get, if things were to get, you know, a little bit crazier here, there's always the option of kind of, stopping exports, right? That I think people forget that the U.S. was, under the Obama administration, we started becoming an exporter again. So it wasn't that long ago that we didn't export energy. So kind of rolling that back, I could see as being a potential solution if things were to get worse. So the U.S. has certain levers they can pull that maybe other countries don't. So it's kind of that geopolitical interplay. I think is really what matters in terms of putting pressure to come to some sort of solution. But ultimately, what this crisis, if we want to call it that, or shock, or whatever it is about, it's the length of time this lasts is where it gets worse. And so I think you're going to want to see parties come to the table to make sure this doesn't last, multiple months, or quarters, or whatever it is, because that is a much more dire solution than if we can figure something out over the next few weeks.
Yeah, I think one of the things to think about too is, while the markets will ultimately, if a solution does, present itself nearer term rather than longer term, when just thinking about energy markets globally, like some of these shut-ins have happened, they don't just turn right back on too. So
Yeah.
there's definitely that to think about when thinking about energy prices broadly, right? So yes, the sentiment will turn when the news happens, but if we're shutting in production across places in the Middle East, that could take a while, and so we start to maybe get some delivery of this crude that's in storage, but getting it back to refilling those tankers again could be a longer drawn out thing already. Like the damage may already be done on that front. But when you mentioned the U.S. and EM, that's definitely been something to call out, is just thinking about, well, what are the playbooks, right? So I think I have this chart here of both equity and traditional havens. It seems that in the past week, investors have more or less fled for the exits, right? We've got the S&P, the Euro stocks, and the Nikkei, futures on the left, as well as the long bond and gold on the right. Everything's down. And so what are some of the reasons that you think we've seen some of obviously the equity side, we've got the reasons there, and we've seen the bigger declines in international markets, to your point, earlier than maybe in U.S. markets. But just in terms of some of the traditional havens, we could talk about both bonds and gold, just quickly what you're seeing and why maybe those traditional havens haven't really held up.
I think in a post GFC world, there have been three things kind of the textbooks say should happen in a risk off or geopolitical shock. One, you would expect gold to do well. The other would be you expect bonds to do well, and third would be the dollar going up, right? We only got really one of those three in this episode. I'd say gold. The reason that happened is there's a context element. Everyone wants to say, well, gold should just go up. It seems like the perfect environment for it, but gold is up 20+% on the year going into this. Had what I would consider a pretty interesting blow off top at the start of the year. So a lot of speculation in the gold market. I also think there's an element that when you have a market that's running ahead of a geopolitical event and it comes, what happens, right? You get a VAR shock, and that tends to make you cut risk, reduce risk, degross, whatever you want to call it. And I think we got that in the gold market, where because it was so strong, you get this shock element that hits the market. And what are you going to do? You're going to trim your winners, right? So I think the combination of kind of this forced degrossing, combined with the fact that you have a lot of speculative interest, to where the gold and silver ETFs were in the top 5 on Wall Street bets, right? So I think you got a lot of stale positioning from that from earlier in the year. So that combination led to gold not being a great risk off hedge in this environment. But I think it's about the context. In terms of the bonds, I would say, listen, in the post in the post 2020 world that we've been in, so post pandemic, bonds and stocks are a lot more correlated to each other than they used to be. I think in the period from 2000 2020, you could sit in a 60-40 portfolio and be just fine because bonds acted as a natural hedge. A lot of that was because we were in a secular decline in rates, and that I would argue ended with the pandemic. So you have rates going up, in a secular sense. And what does that mean? It means like the bonds aren't the exact same, natural hedge they used to be. And the fact of the matter is, when you've got inflation, higher than target for going on 5 years, you get inflation kind of spikes or potential risk related to inflation, like this move in oil suggests or is, that makes bonds a little bit less of a safe haven instrument than they would be in prior times. So I think that kind of explains the bond side. And I would think dollar's done kind of what you thought it would. I think last year, especially during Liberation Day, and also kind of in that tactical strike, against Iran, you didn't really see the dollar do very well, and I think people started to give up on the dollar being a safe haven. But a lot depends on the type of event that causes market turmoil, right? I think in this case, there's very much a terms of trade element, which is a fancy way of saying, we've seen over the last week, if you're an energy exporter, your currency has done pretty well. If you're a net energy importer, you've seen weakness, and that just comes down to the fact that if you're Japan, then you have to sell a lot more of your goods to buy the same amount of oil you did a week ago, right? So that terms of trade element creates a flow effect that we're seeing kind of really driving the FX market right now, and I think that's really what's helped the dollar. I also think things like places like Dubai, we're kind of becoming the Switzerland of the region. You see that kind of coming under attack. Money's going to flee. It's going to go into a region where it knows it's safe, and that's been the U.S., right, amongst a couple other places. But I think that element's what really been driving it. But it's just what I'd really drive home here is that it's not every crisis, every shock to a system is not all the same, and you have to kind of know what your setup is going into that to know what a proper safe haven is going to be. And it's very easy to look back in the rearview mirror and say, oh, that makes a lot of sense. But I think understanding like how gold was set up going into this, you could have made a fairly reasonable assumption that it might not be the greatest risk off hedge in this environment because it was so strong going into it, because of these other dynamics I talked about. So that's another reason why you diversify, right? If you want to have these types of things built in a portfolio, having a few things in there so you can be insulated is what makes a lot of sense. Because it can change, and we've been seeing that over the last 5-10 years. There isn't one textbook answer to these things, and I think that's really what I would drive home, is that that understanding that you probably need to be diversified across a few safe havens if you want to kind of dampen your portfolio. It probably makes the most sense.
Yeah, I think that makes total sense. And I think even despite this, you've seen a lot of commentary on Twitter, asking about, oh, how's that international reallocation looking for you now? I think long term, we talk about this a lot. We've looked at EMs and developed market ex-US, but particularly EMs, and I think there's still that long-term case is there. But of course, when there's shocks like this, there's going to be volatility. And so to your point, having some cash and for these type of events, and having what I would say vehicles or managers or what have you that can capture some of these other trends that are playing out. And so we've talked about cash, another area when we're looking at potential safe havens. There's been on the agricultural side, we're looking at agriculture, grains, and wheat in particular, as well as urea, which is the largest input into fertilizers across the world. So this is one where these have all seen some pretty notable spikes here. Now the data series are admittedly volatile just even in this last year, but the one thing is clear that since this broke out, they've gone straight up. So it's another kind of area where we thought maybe not in your traditional playbook of safe havens, but definitely something that's been working.
I'd actually argue it is, right? If you look throughout history, whenever you've had wars, food tends to do pretty well in that because food tends to get destroyed during wartime, especially if it's you know, uh, a bigger type of conflict. It's like that is a risk here. I mentioned earlier that a third of these fertilizers are moving through the Strait of Hormuz, so that's part of the story. But historically, um, things like agriculture do well. So you could say it is kind of a textbook hedge against this type of particular event. I think in this particular case, what's interesting is that you're getting this potential shock right at the start of growing season for a lot of the major agricultural products. So how that plays out, might not be an immediate story. That's another thing I would argue here when we talk about geopolitical impacts on the markets, is that the markets have become very, very short-term focused here over the last few years. So people like to say, geopolitics doesn't really matter. The market always comes back, and that to an extent is true. But I would argue a lot of times there's a lot of butterfly or knock-on effects that happen because of the geopolitical event. The one I always talk about is what we saw in the gold market. It's very popular to say that the Russian invasion of Ukraine didn't really have lasting impacts. I would completely push back against that. What we ended up seeing was, prior to the invasion of the Ukraine by Russia, gold pretty much traded lockstep with real rates. And that dynamic completely flipped because what ended up happening was the knock-on effects of that geopolitical event ended up making central banks in the Eastern Hemisphere start to say, I have to diversify my reserves out of the dollar because there's a good chance if I don't fall in line with the West in terms of politics, I could get my assets seized. And we ended up seeing kind of a structural shift in the gold market. So there was a very huge impact from that geopolitical event. It's just a lot of it comes down to time frame. And I think one of these things that we could see is going into, like I mentioned, going into growing season, kind of seeing this bit of shock going on in the fertilizer market, could have impacts on agriculture in the next growing season. So it's things like that you have to be thinking about in this type of environment and kind of step away from the short-termism, because these things will have impacts and there will be opportunities as well from it. So that's the way I try to think about the markets when these type of events occur.
It makes me think, the market is either so short term, or you've got the other crowd that, oh, well, nothing ever happens long term. We're just, stocks for the long run or what have you. And I always think about this maybe morose, but it's like, yeah, sure. But, we all also know what in the long term, right? So you can put anything on that long-term chart and it doesn't really, what else really matters. But okay, so thank you. That was a great run through on all the geopolitical stuff. We did have one last topic here. I called it a canary in the data center. We had a headline on Friday, nicely buried, by the way, I'd say, but the OpenAI and Oracle made big news last year talking about this Stargate expansion, these huge data centers building out, and they are still building it, but there were plans to make it, even bigger, a 1,000-acre data center. Well, they've kind of come out and said, OpenAI's plans have changed a little bit, and they're not necessarily going to build that data center. News followed up that NVIDIA's working with their data center builder Crusoe and Meta to potentially take on that lease and build that out. But this is really kind of the first big negative news I feel like we've had in a trend here that's just been nothing but more deals, more building. We're going to build data centers. That's going to save the economy. Obviously, haven't seen anything in the numbers yet here, but we threw together the 2026 calendar year capex estimates for 5 big hyperscalers. Um, you know, Amazon, Google, Microsoft, Meta, and Oracle, since they joined the party. And these numbers have grown to north of $700 billion just for calendar 2026. No rolling over we've seen in any of the data yet, but just thinking back on history, there's always some event, right? Whether it's a cancellation or whatever, something that starts to maybe pull the shine off some of this nothing but growth stories. So we wanted to call this one out. We also included a chart from last week because it's still relevant. But any thoughts on this? I know that digging into the individual names is generally more my lane, but this definitely has big macro impacts too with the growth story that we'd see in the US.
Yeah, we'll see. I mean, I'll be curious to see if somebody else steps in, right? Because that would tell you maybe it's more micro than macro. If we were to see kind of one of the other hyperscaler shops kind of come in and say, you know what, I'll take over that project, or makes sense for me, or whatever it is, then I could see the market kind of say, no big deal. So that's kind of what I'm looking at. But I don't disagree with you. In terms of these things, there usually is kind of one point in the cycle where something happens and kind of that changes the narrative. So we'll see if that's what's happening here. I think it's a little bit early here. We'll see how kind of the chips fall, but clearly something to be monitoring, because it does have potential narrative change impacts, right, or implications.
Yeah, definitely. And like I said, shout out to Lawrence Gillum from last week's episode. I was working off that deck. I was like, well, this definitely fits right in, and you can just see that the amount of debt kind of coming out of investment grade technology is kind of at all-time records as of last year, and I believe that the numbers will continue to grow. Well,
Yeah, I mean, there's kind of two schools of thought there, right? That I've kind of been running up against. One, if you want to compare this to like the 1990s, the debt is what really kind of drove that overspend. So kind of, what I mean by the two views is there's some that are out there saying, it's been cash funded for the most part up until now, and we're just starting to get in the phase where debt's being used. So this could have a lot more to run. And the other side is that, well, maybe it doesn't have to, because so much was already spent leading up to this. Maybe just getting, moving into the debt phase is signal enough. So, I'm not smart enough to know whether, if that's the right way to look at it or not, but it's something I think to think about in terms of maybe we do need kind of an Uber debt cycle first before the overspend kind of question becomes a real thing. That's something I'm thinking about, but take my cues from the price action over anything else.
yeah. Well, we've come to the end, and we're thinking about the rest of this week. We've got some big economic news on the calendar. I've highlighted what I think are the obvious big ones. We've got CPI on Wednesday, jobless claims on Thursday, and then on Friday, PCE and some sentiment, as well as JOLTS. Is another one I didn't highlight, but the quits level can kind of give us some reads on maybe what's going on in the job market. Anything that you're specifically watching, either those I highlighted or otherwise?
The inflation number will be important, although I wonder, how much will it really matter given what's going on in the energy market, and kind of will it be looked through, because you could say it's stale. I think Friday's number was somewhat kind of looked through because of the changes to the birth death model, and also just the weather impacts. You might have a similar kind of effect here, but honestly, I think from what's going to drive the market, it's going to be any news out of the Middle East one way or another. That's really what's going to drive things here, and I think the data for the most part comes secondary in this environment. It's very fluid. So I think Middle East right now is going to be trumping most other kind of known event risks here.
Yeah, I agree. I think the number on Friday was interesting because it was kind of looked through because of some of that noise in there, but it's still, to a non-economist, I'm like, well, didn't the consensus and the survey participants also know that, and yet they were
Right.
still wildly wrong. So interesting stuff. Well, thank you so much, Kristian, for joining, and a lot going on. We'll continue to watch, news out of the Middle East, and be back next week.
My pleasure.
All right.
Thanks for having me. See
Thanks.
ya.